Hello, folks. Welcome to Market Trends. I'm Dave Russell, VP of Market Intelligence at TradeStation. And I'm going to quickly zip through these disclosures. Remember to go to tradestation.com and then go to Research Insights at the top of the website to get to the Market Insights blog, where we have the information about today's webinar. This is a very interesting sort of market we're in right here, because in some ways the Fed gave us everything that we've been wanting for the last year pretty much, and market trying to bounce on that. And now we're kind of in this crucial period, last 2 hours of the session, and the S&P is in some interesting sort of price areas. So I wanted to cover that now. All right, so if you're on tradestation.com, go to Research Insights. Also, if you have any questions, please ask me in the chat. All right, so go to this article right here with the Wall Street sign, and this has basically a rundown of what we're going to be going through. And I want to show you, I have a new kind of strategy thing for you. I want to see if I can, I might be able to very quickly get, let me just very quickly try to get this into, I'm not going to have time to actually publish the ELD, but I'm going to show you the easy language, and then I can share it with you guys next week, or you can email me. An interesting sort of thing I came up with based on some of the stuff I've noticed on some of these nice inbuilt indicators that TradeStation has. So all the materials I have are based on these ELD files. These are zip files that have ELDs and workspaces in them. You want to load the ELDs first, which will then have all the indicators. And then after you have that, then you can get the workspaces. And these are the standard workspaces I use for market trends. Start with MT Main, which is my big kind of overview looking at the market overall. And as I look at this, there's just, a few things that come up really, that kind of pop up here, which is semiconductors, technology, and gold miners. So you can see this here. And what's very interesting to me is that, today, I think it was both of these were today, the Bank of England and the Swiss National Bank raised interest rates. And yesterday, the Federal Reserve basically said they're done raising rates. Now, you can debate exactly what's coming next, but it's a very interesting setup. And it's one that is very positive for, for things like gold in particular. So it's kind of interesting. Now we're in this period of real sort of, weakening in the US dollar. And, a lot of the things that were negatives on us are now kind of positive. And what's interesting is right now we're seeing a total collapse, and everything that's kind of cyclically, a driver aside from semiconductors. So I think it's going to be interesting to kind of see, does that spread to semiconductors or not? I don't know. I think this entire market right now is in a very strange spot. I think there's a lot of sort of correlations between interest rates go up, so you buy oil, you buy small caps, you buy cyclicals, and I think there's a lot of correlations built into a lot of trading systems. So now we're at a spot where, as interest rates come down, it's really having a beating on the energy stocks, which, in many ways is good for the overall market. I mean, this market was dominated by big tech and growth stocks, and those areas are doing, pretty well. So wanted to just kind of highlight that, because it's an interesting sort of reversal of what we saw for most of last year. So now, if we just kind of start off by looking here, at the very top here, this is basically the chart I wanted to show. And if we look in here at the S&P 500, oops, we pretty much have, the 200-day moving average, the green line, and the red line is a 50-day moving average. Yesterday we smashed down, we tried to come up, but what we have here is we're basically, unless we really sell off late, we're going to end up with an inside day here. And it'd be, we'll see. I mean, I'm, my perspective here was that the market would react positively after the beatdown yesterday. My view has been a few things. First of all, if you look on this chart here, MACD has turned positive. which is interesting. There's also an indicator I sometimes look at. I think let's just I don't actually have it on this chart, but it's a 10-day simple moving average, which I actually have. I'll just show there's a trading view chart, but I have it on this one. It's this yellow line. I generally believe that I've noticed that this is a pretty interesting and useful directional indicator. And when you look at this, we're back above the 10-day. When we were up here, we were really overbought against the 10-day moving average yesterday afternoon. And now we're just kind of holding. But right now we're above the 8-day exponential moving average. We're above the 200-day moving average. We're above the 10-day simple moving average. We're also above 39.50. So 39.50 was a level. If you look here, 39.50 is right about here, and this level was pretty much the kind of this low from earlier in the month. So earlier in the month, the S&P slammed down this level between kind of 39.30 and 39.50. We came down and then became like this sort of level we hit. We tried to break. We squeezed that right here. We broke out above it. Now we came down and kind of tested it again yesterday and got right back above it. So, this is something I think now is kind of an important thing. But, it's funny because like you guys probably seen that movie, like Pulp Fiction, there's that song Stuck in the Middle with You. And I kind of feel like right now, that's where the market is now. It's kind of stuck in this spot where it's like on one side, we have this idea of there being some kind of financial contagion or bank meltdown. Then on the other side, we have the Fed pausing and all kinds of interesting things happening in tech and growth. My perspective would lean more toward the idea of it being a positive scenario because of the fact, like I said, this market is, dominated by the large growth stocks, and strength in the large growth stocks is generally going to be positive for the S&P. Now, the other thing is that weakness in the dollar and lower interest rates are also overall kind of positive. But just look at this here. This is the growth versus value. And look at this divergence between these two. And if you actually look here, this other article we did recently on Market Insights. You go to the main blog here and look at this. This is the article I did on Monday. This shows a comparison of 1 week relative strength in the NASDAQ against the S&P 500. One chart I looked at said it was the highest since 2008. Another one said since 2002. And I'm not sure exactly. One was on TradingView, one was on TradeStation, but I'm pretty sure TradeStation one is correct. And it says this is the highest relative strength in the S&P since at least around 2002 when tech was still big. So this is basically this is the NASDAQ's 1 week change minus the S&P's 1 week change. It was 440 basis points of outperformance in the NASDAQ last week. When you see these kind of surges of relative strength, that is, it does say something. Usually things like that don't happen just like kind of a one-off. There's usually some kind of, bigger thing that's taking shape here. And my perspective here is that we do have right now the potential for a significant rotation back toward growth stocks. It kind of seems to be happening. It's what we're seeing here with this relationship here. Look in the last month, growth stocks are up 3%, value stocks are down 6%. On a year-to-date basis, which is also important because we're getting to that point now where it's like we can start talking about 2023, in terms of like having a character, in terms of having patterns. And last year started with the tech stocks getting destroyed, with energy stocks rallying. Look this year on a year-to-date basis. What do we see? We see just the opposite. We see the cyclicals like energy and financials and small caps all struggling. This is the polar opposite of last year. And now we're seeing that strength in the growth. So there seems to be something happening here in terms of growth coming to life and the weaker dollar trades kind of coming to life. And I just wanted to kind of highlight that. If we actually look on just like a daily basis here, it'd be interesting to see who's down the most. Today, it's the banks, energy, kind of retail. So that is, I'm just looking here at the performance. These gold miners just keep kind of moving up. Now, 2 weeks ago, I had actually been looking at gold, and to me, I was like, at that point, I was still expecting the hawkish Fed. It was kind of right at the cusp of the banking crisis. But now when you take a step back and look at it, I think it's important to realize we did analysis in TradingView a while back, but there was a level here, and this is on physical, I can show you the futures, GC. All right, so basically 1800 was a big breakout level kind of right around here. And it happened really early in the year. So another aspect of this year, if you want to talk about this year as being a thematic thing, is strength in gold. So it's interesting that gold 1800 was a big level that went actually all the way back. I think if we look on like the weekly chart, way back on this 1800. No, yeah, go back further. Let's go back to like the monthly. I'm sorry, this is not as clear. There's another chart. See, TradingView has this other thing, which is like the spot XAU USD. This is more of like the spot price of gold and not the futures. But if you look at this here and you look at 1800, this was a high right around here, 1800 from October of 2012. And if you look at that level right there, and then you look at this on like a daily chart here, this year, the beginning of this year, we basically took this out, came back and retested it. And, obviously, hitting highs here, but at this spot, when you really look at gold, it hasn't really gone anywhere for, since the pandemic started. It's kind of interesting. But when you think of this situation of what the Fed just did, the argument is now lining up in a way that's kind of favorable for precious metals. So I wanted to just kind of point that out because, this year there are themes emerging. Like I said, let's do one more thing here. Year to date, what are we seeing? Semiconductors, growth like communications, tech, and gold miners. Now, the housing stocks continue to do well. Also, this remains to me something that I think remains kind of an under the radar trade. I'm not too in love with it at this exact moment, though, because it's a consumer discretionary. If people start to talk about recession and stuff, I mean, I'm not so sure. I mean, today KB Home had some strong earnings, but we also have to be careful if people start talking about financial problems and stuff like that. So I wanted to just kind of point that out. I'm not super clear here on what to make of home builders. This is where the S&P actually is on the cash. We're at 39.60. So we're 10 points above that level on the cash that is important. So like I mentioned, the MACD having turned higher to me was actually an interesting sort of pattern. What is this doing? All right, I'm just gonna hide my scanner. What's also interesting though is I'm watching the VIX around 20, and it's staying above 20. So I mean that is something here I think we need to be aware of and kind of be careful of. I think also we have to realize when you look at the timing, we go down here, look at the bottom where I say upcoming events. There's not a ton, and I think that's actually it's a good thing and it's a bad thing. But the thing is right now there's really nothing to kind of hone into. We're literally just stuck right in the middle of a range with not a lot of real kind of clarity. So from my perspective here, it's a question of if we see the 39.50 holds, and the market, in my view, can kind of chop and test around here for a little while, staying above the 200-day, and and let that MACD. Let's see if that MACD actually takes some time to kind of confirm, because we look here at the way MACD often behaves. What you'll see is that the MACD here, you can see where it turned negative. So it turns negative, and the market drop didn't really come for several days after. And here the MACD turns positive. So the same thing. It could just sit and grind, and start to build. And I think that's what we want to look at. We also need to be aware of this trend line coming down here. So it's just kind of a sitting and pausing and waiting sort of thing. All right. So, like another thing, the existing home sales were good this week. From my perspective, it's not, like I said, to me, the real issue with housing right now is the fact that you have a peak in interest rates and the fact that the demand that's on the sidelines is pretty significant any way you look at it. So I think we all know about the Fed yesterday, and they talked about this idea of the banking situation, squeezing the economy and stuff like that. I mean, it sounds scary, but in some ways, it's kind of an ideal situation for the stock market, because if it just slows down demand to a certain extent, tightens financial conditions without the Fed having to hike rates, it does a lot of positive things. So I think right now, this backdrop to me, when you look at it kind of thematically, when you look at the actual news flow that's happening, is in my view increasingly positive. Because we're now seeing a situation where there's all this AI happening. We're seeing the cost cut. I'm going to get into that. Let me just cover that. But we're seeing positive things happening in the big growth areas. We're seeing stocks fall in like the cyclical names based on fear. But I wanted to show you something. This is the Atlanta Fed GDP, estimate. Now, I mean, people say that it's like a certainty we're going to have a recession now. Now, this number is crazy and it goes all over the place. But the key point is it keeps going higher. Today, jobless claims were lower than expected. So there's really nothing saying recession aside from somebody's model. And I just think we have to realize that, because people, at the end of the day, a model is a projection. And if it's a projection, it's really the future. It's a belief. And a belief is what? It's a wall of worry. We believe that there's going to be a recession, and therefore there's a wall of worry. And I think that's what we have now. All these models, and I just keep hearing these people like go on CNBC and they say things like, well, we know there's going to be recession because of the yield curve and blah. And they keep saying it. And it's like, well, there isn't one. I mean, the numbers don't have anything remotely recessionary in them. So, this is a sort of situation, in my view, that is potentially bullish, because people keep saying the world is going to end and it doesn't. And the sentiment, if you look at the American Association of Individual Investors, this number remains near the lowest level since September. The bullish number around 19%. So, I mean, this level was the lowest since September 22nd. You have to dig back in the data to see it. But if you look at the S&P on September 22nd, where was it? I mean, it was basically right about here. It was bottoming. So, I mean, same sort of situation. Although I still think right now we just kind of need to watch the VIX, see does the VIX explode higher or not. And I think in the near term, without a lot of like clear other news or anything, we're kind of in this drifting area at this moment. All right. So Tesla's had some interesting news recently. It got raised to investment grade, which is always an interesting pattern. I mean, I'll say, I don't have a massive amount of respect for the credit rating agencies on certain things, especially when you consider that. I mean, I think they had some of these banks at investment grade right before they went. They had bank runs and stuff, and they make a lot of mistakes when it comes to things like structured products. Anyway, but they often notice like real improvements in a business, and I've noticed when they actually make upgrades or downgrades of like corporations that are real businesses, they often catch like long-term improvements or deterioration in businesses. In my opinion, from what I could see, I remember back when the newspaper companies were still trading at highs like Gannett, and Moody's and S&P were very early to be the ones who were bearish on them before the equity guys were. So there's a certain thing to be said for the credit people, and they they basically raise them to investment grade. And then there's also two separate numbers showing strong sales of Tesla in Europe and China. And don't forget, we're going to have deliveries in early April, which is now in about, their deliveries are going to be on the 2nd or 3rd, or I'm sorry, the 3rd or 4th of April. That is something else to kind of bear in mind. That is often kind of a positive drag on the stock. To me, Tesla is actually a pretty interesting name. We did an idea on TradingView over here. It worked at the time. Now it's pulling back. We did it when the stock was, it's up. Where is it now? It's pretty much right back where we wrote it. At the time we did this, it was at 92, but it jumped and then it pulled back. So, the patterns on this were interesting to me because, you basically kind of see the 50-day coming up, and there is this level here, from back in November. So this pattern, the RSI turning higher, has worked a few times. So I want to just point that kind of out in Tesla because, actually, no, when we did this article, it was at 186 right here. So it's up from where we published it, around 182 or something. Actually, I'm sorry, we did it right on there. Remember, it was like 182. So it's up like 10 points from there. Hit 200, pulled back. And now let's kind of see what it does. This to me remains a pretty interesting story when you look at this. It's actually pretty tight when you look at, Tesla historically. This is a lot of inside days today when you look out here, like Tesla and the SPY. There's probably a lot of other stocks that have inside days. In fact, let me show you a little something if you're curious. I'm going to create a new radar screen. I just thought of this now, but let's bring in the S&P 500. Let's set it to daily. And then look at this. You can go to studies, add study, go to show me. Inside day is a show me. Okay. Inside bar, hit yes. And then let's let it populate. Now, just if you're curious, the difference between a show me and a study is that a study will always populate and a show me will only populate when something happens. So a moving average will always plot, but we can say here, go to studies, add study, then go to like show me, and then go to, inside bar. I have this other thing over there that's a show me that says low for day, and I got it to talk to me. So it's on my other computer. So it's the S&P sitting a low for the day. So it's yet to show me. If I hit this, you can see, well, this is an inside bar. Maybe it has to finish for this to be done, but this here is popping up as an inside bar. See, what it will do is it will pop up. It will actually show a number. I think it'll show the last. So you can always see, there's probably others, but if you look at some of these, like Exxon is apparently an inside bar. No, you know what? That was yesterday. These are showing values for yesterday. So it doesn't work on an intraday basis. But I want to just kind of show you that's the sort of thing you can pop up quickly. This is always something that's useful to kind of run, like to look at in the morning to have a sense of what happened yesterday. There's a lot of attention about NVIDIA. They did some kind of conference when they were really promoting their artificial intelligence. There were multiple analyst notes about NVIDIA as an artificial intelligence play. Meta Platforms has had this a lot of cost cuts that got upgraded by KeyBank. And what's interesting is, like I said, the cost cuts has been a positive. GameStop rallied after earnings, after cost cuts drove a profit. FedEx has cost cuts. Amazon cuts jobs. So all this is kind of interesting because I want to mention that one of the catalysts now we're seeing is cost cuts and what it means like for margins. And I do think, a lot of these big technology companies, they have the ability to be boosting profits by cutting costs. And that's kind of an interesting catalyst to be aware of. Second. Also, it's interesting, Krispy Kreme has had a series, I don't know much about this company, but it's had a series of positive sort of catalysts lately. Now, a company like this people can view a company like this as being kind of like an anti-recessionary sort of stock, because, things like donuts and stuff are not like super high end. They're selling at McDonald's. And it's an interesting sort of narrative. They've had some interesting little business popping up recently that we highlight here in the rundown that might be worth a look. As I look at these different things, let's look at a name like, these are different signals that we look at, and a lot of these have had like golden cross. Adobe also, we had mentioned this one that was interesting because they actually come out with a good earnings report. They have this whole AI thing that's kind of coming. You see the 50-day moving average rise above the 200-day. This was a strong earnings report right here. And it's interesting because we did a bearish thing on TradingView on it when it was right here, and basically went down pretty good. But now you're seeing essentially that this company, is, I mean, it's important to realize that Adobe is a major growth name. It's a big name in the indexes, and it was a huge name when things went up. And it was one that, like, I'll be honest, I was super negative on it. I did multiple bearish trades on it on TradingView that worked because it was just in a bad downtrend. But now the 50 days above the 200-day, and it's not really a downtrend anymore. So this is actually one I think that we want to kind of be thinking about and being aware of. This is interesting. Exact Sciences. This is an oncology stock. Most healthcare has been pretty bad, but this is a name I was just watching, kind of holding this level. I mean, I'm really not sure what's going on with healthcare. I think most of them are looking pretty bad to me. There's certain things I think that are going to be, like I said before, and actually I don't have the details on it now, but I mentioned this a couple of webinars ago. I said when they actually somehow fight out this budget this summer, there's going to be ugly stuff probably for healthcare. They're going to take a pound of flesh out of reimbursements on Medicare and other stuff. And a lot of these things are very hard to figure out, but they're already talking about it on multiple fronts. I think they're going to be, negotiating, drug prices and stuff. It's kind of like, the thing that it's the nightmare of healthcare companies. But I did want to mention that Exact Sciences, if you look, this has been a long-term, interesting kind of growth name, and it's trying to kind of turn bullish again. So I just wanted to point that out. Tesla also has, like, the MACD on Tesla was starting to turn positive. I don't have MACD on this chart, but I want to just mention a few things. It was interesting. Wait a second. Walmart. This is supposed to be McDonald's. I don't know why I said Walmart. I remember I was looking at Walmart and McDonald's same time. McDonald's here is the one that was interesting to me. When you look at this, it's just in an extremely tight channel. It's also the kind of stock that is just kind of on its own program. It's an interesting name. I mean, it's like it doesn't seem to follow any other macro sort of themes in terms of consumer or economy. I mean, if there's a really bad economic situation, it'd be bad. But what's interesting to me about McDonald's is this is an all-time high on McDonald's. Like, right, this is a previous all-time high. So it basically broke out late last year, and it's just kind of held and chopped along there ever since. So it remains a very interesting sort of thing. And the other one is Ford Motor is in, this is like a bearish triangle that's kind of taking shape here. If you look at these highs, a few different ways to draw it. I mean, I'd kind of draw more like this and not even worry about that. But, to me, this low would not look super secure. The other one, let's look actually now at the IWM, the Russell 2000, because, this is actually, this was a level that it came down and hit, and it's not holding. So, I mean, at this point, the small caps look like they want to, move toward those October lows. All right, another one. Now, this market is getting more bearish than I expected at this moment. So I'm going to just cover a few of these things I was looking at. And I mean, I'm not sure if I missed something, but Carvana was one I had wanted to mention because, and the reason I say this is because they have a lot of debt and they're looking to kind of restructure it. At this point, I mean, to me, it was one that was kind of, I was suspecting that it was going to kind of gap here and hold this area and, potentially have a little bit of, bears getting squeezed out. But, this market is not holding the way I kind of expecting earlier. So, wanted to just kind of point that out. This is something here that I want to just mention. They had a lot of they have this thing going when they're going to try and get people to term out debt. Now the thing is that it's not clear that the creditors will accept it. So if the creditors don't accept it, this could be the end of the road, so to speak, for for Carvana. I mean, basically, they have a massive amount of debt, a huge amount of short interest. But if they can buy time, that's the sort of thing that could potentially, squeeze in a positive environment. But now we're seeing the VIX back above 23. So a lot of that is not as clear now. The other thing I want to show you was I'm going to very quickly just bring up this chart. Actually, you know what? This is let's just look through and see if we have any idea of really what's happening here. If we go to the price grid of this is the S&P 500. If we just look at like today, for example, the Tesla's now negative. Go to general, go to reference rows. We're under 39.50 on the cash. So if we look here, we can see that the S&P today has how many companies are actually even green. And let's see, the actual index itself is up a very small amount now. And with the index up, there's like 200 companies. So the overall mix is still pretty not particularly positive, and we're seeing the large cap companies. But what's really interesting, I mean, is just everything cyclical is getting crushed. And if you learn risk on cyclical here, they're all bearish. And I think it's also, you're going to point out, last webinar, the energy ETF was down at these lows. This was last Thursday, was right here. And I said at the time, let's see. I said at the time that I thought a good risk reward was being long energy because of the fact that there was the banking crunch in the US wasn't going to like destroy global energy demand. And it did have a decent bounce. From my perspective, these sort of moves are things that don't, if you see something at a really deep low like that, you get a snapback, and that's often all you get. But often when things are this beaten down, you just get the snapback, and the snapback is a decent sometimes it can have a good risk reward when it's something that is kind of extreme like this. But it's interesting to see that like everything cyclical here, like energy, small caps, financials, all getting hit. And to me, that's actually, we have to be careful with the semiconductors here. I'm really not sure, if the semiconductors can continue this move, if we continue to see this anti-cyclical move in the market. So this is an interesting just sort of mix here after yesterday's chopping. And to me, it's an interesting sort of confusion. I mean, we've never really seen anything like this with financials, because at least I'm not aware of a banking crisis being caused by mismanaging duration. It's usually caused by bad loans, speculative loans, and things like that. And now we have this other thing that's just very strange, of money shifting from regional banks to big banks, and then that potentially pulling lending capacity out of, ordinary banks. And honestly, it's not clear what it is. When we do stuff as traders, we look for trends that we can recognize over time that repeat. And this is not a trend this is nothing we've ever seen before, at least not that I'm aware of. It's probably happened in some weird random cases, but we're looking at something now that I don't know anything like the trend that we are now seeing. It's interesting just to see what's happening. So I'm kind of at a loss here, and I think the VIX is going to be the thing to watch. That's kind of where I have my attention focused, and I'm just looking at essentially the VIX. I'm looking at 39 kind of 50 on the S&P. I'm looking to see the 200-day moving average. Those are the areas I think right now. Now, there is another thing, which is basically, if we look at the treasury yields, I haven't looked at those since the morning. I mean, this is the 10-year. On my other computer, I actually have the the 2-year. I want to see the 2-year note, the 6-month and the 2-year. This is over here on US 02Y. This kind of price action is interesting, and it looks actually, pointing lower. And it's interesting because Paul Tudor Jones said the thing that the market needs to rally is for this to go down. And when you look at this, how fast it dropped, and if you look at the price action now on this, I mean, you have basically like, something of a bearish triangle there. So to me, that's kind of what we've been waiting for. This is what we've been waiting for. And the question now is, does the reality of low rates, what is worse? The fear of some kind of financial crisis that it's not really clear where it is. I mean, if you look at like Fred, they call it Fred high yield junk bond spreads. I mean, they've gone up, but I mean, look at history of this thing. I mean, they're not very high. This is this is not much of anything. So there are other things I think you can look at with the interbank stuff that I'm not as clear how much it exactly means, but I'm not sure I see like any real confirmation here that we're tipping over the edge into some kind of major depression. To me, it continues to look like the worst thing that happened to us, meaning the Fed hiking rates, is going away, and that has more of a positive impact than a negative. So let's just kind of see how things work out. Like I said, this is more of like a kind of a philosophical or an actual thematic thing. The idea of interest rates coming down at the same time that growth stocks are outperforming. It's just an interesting sort of mix. And I think there's a lot of people, honestly, as well, who were probably overweight. There were a lot of people who've been buying the cyclical stuff. And I know like some professional bond traders who got really wrecked with this. I was talking to a guy, he's like, no, we're going to 5% on the 10-year. And I remember telling him, I remember seeing, look at that abandoned baby. And I was just like, I don't know. I'm not a bond guy. I'm not going to argue with him. But like, to me, this looks like there's probably some people who are going out feet first in a body bag after this move. And it's probably going to have some overall impact. There were probably a lot of people who were overweight, a lot of the cyclical sort of stuff and the value sort of names. They were looking for yields to go higher. And this sharp change of stuff, I think, has probably just disrupted a lot of things. So, like I said, I think it's important to realize, though, that this is really a very unusual environment. All right. For previous recessions, did the consensus believe a recession was coming, or was it a surprise? I think that most people didn't believe it was coming. I'm looking back to like 2007, 2008, and there were a lot of people who, from what I can tell, I don't remember a lot of people really expecting a recession. But I think that this is also, we're in a situation here where it's pretty difficult to really anticipate much of anything, because I think that we still have, it's like a knock-on effect where basically the coronavirus caused a bunch of craziness, and then the craziness that caused the Fed to be crazy, and now we're undoing the Fed's craziness. So I think we're in like the final stages of returning to normal after what coronavirus did essentially disrupt the economy. And it's funny, that was like 3 years ago. Remember March? This is literally, it's almost exactly 3 years since the market bottomed coming out of coronavirus, where we sit right now. All right, there's one last thing I want to show you guys, and this is what I did not yet have a chance to do. But I go to breadth, and I go to I'm sorry. I'm going to copy this chart, and you guys have this chart, and then I'm going to paste the chart, paste window. All right, so we go to data, edit symbols. I'm going to remove those. I want to keep the stocks above. All right, it's data 2 and 3. All right, so close. Now, I'm going to go to strategies, add strategy, and I have this strategy that I'm going to give it to you guys. It's called multi-data crossovers. If you want to see edit easy language. So if you can see this, I'm going to put it into chat right now. What it does is that when the data when data 2 crosses over data 3, then buy next bar. So this is a pattern I noticed, and I'm going to add this now. I'm going to go to add strategy. Okay. And then I'm going to make it so here, let me just show this to you. It works on the long side, but not the short side. That's what I noticed about it. Wow, this market is fighting to be an inside day. It's desperately trying to stay above yesterday's closing low. We'll see. It doesn't look good. Anyway, so it has a bunch of, it does short trades, but the short trades don't work very well. So this is what it does. When the blue line crosses over the red line, it buys, and then it goes short when it crosses under. So the number of stocks above the 20-day moving average exceeds the number of stocks above the 50-day moving average, then it considers it to be a bullish signal, and vice versa to the downside. So this is basically a pattern we've noticed before. And I've noticed that this is actually a pretty interesting pattern. If you use the strategy as a back testing, it actually does confirm that this pattern has a historical causation. So we look here, we go to data, and then let's just see how much history we have. Right, we have 10 years of history. We go to strategy performance report, and if we look at this, we can see that this strategy over time is profitable. What's interesting is that the short trades are not profitable. The long trades are much more profitable on this side. So if you look here, we can actually see that the number of trades we see that it's going to match, but we have way more profitable on the long side than the short side. So we can go up here. We can go to this strategy now. Go to edit strategies, and we go to, we're going to set it to turn off selling short, and then hit OK again, and then go to data. And now you'll notice that all the negative ones went away. And now the inside day is gone. And this looks like the bears are now pretty much in charge of this. I don't know. This is VIX is really popping here. So there seems to be more fear about something in the banking system. That's all I can say. This is it's interesting. All right. So long, and you can see here that it basically has, where's it? I'm sorry. It shows that the average winning trade is $660, and then the average losing trade is $378. You can play around with it probably to do some other stuff. I like to look here at the performance graphs, because what you can see is that some of the biggest drawdowns were things that were kind of they would have been kind of stupid to have acted on. In particular, it had a signal. Right. There was one recently that was a really bad one. This one was really bad. The market was tanking. It had just a quick counter trend move, and then it got slaughtered. So anyway, I want to just kind of show this to you guys. You can see how essentially the language works. And if you email me at drussell@tradestation.com, I will send you the actual study. I will also include it next week in market trends as one of the zip files. So I want to just kind of show this to you guys, because this is interesting to me, because you can use multiple signals. You can basically use one data to trigger another data. So you can say something like, if VIX turns positive, then sell the S&P, or something like that. So I wanted to just show you that this is some interesting sort of stuff. This works by having 3 data points on the chart, and that's basically the the underlying principle of it, and then one triggers the other. What is the indicator name below it? Is hard to read. This is the same thing if you go into the MT breadth workspace that we've shared with you guys, which is this is two different indexes that show the stocks above their 20 and 50-day moving averages. So that's what you have there. And there are, if you dig into it, you can see that these are listed as data. These are not actually indicators. These are actually data. You go to edit symbol, you can see it has data 1, 2, and 3. All right, well, those are most things I wanted to. Can you set alerts on this strategy? I'm sure you could, but at this time, I'm not sure exactly how to do that. At this point, I want to simply show you how to, you can make an indicator that would do the same thing, that would basically look at them and then it would send alerts. You could do that. I'm not sure if a strategy can send alerts, but there's ways you can do it where if you have it set up, like using, it'll actually show up as being like an order or something like that. If you use it this way, it will, it'll actually make a trade, which would be an alert. You could do it in a paper money account, or you could do like one share or something of SPY, and then you could use that to do triggering, or you could use the same logic in an indicator, and instead of buy, it would be alert. It would be the command you would use. So the last hour of this day is going to be very interesting. We will see if my expectation of a dovish Fed being positive pans out, or if it turns into just a big meltdown and wave of negativity. Those are all things I wanted to cover. Yeah. All right. Let me see if I have any questions. Can you share your inputs number for the Golden Cross study? Go to breadth, go to the MT breadth workspace, and they're there on the SPY chart. What would happen if there's recession according to economic data? Well, technically, recession means you have 2 quarters essentially of economic contraction, although it's also kind of defined subjectively by the National Bureau of Economic Research. And, traditionally the idea is if there's a recession, it's going to hurt cyclical stocks. And that's what we're seeing: financials, industrials, materials, things like that. Be bad for consumer discretionaries, which Tesla is a consumer discretionary. Be good for bonds, good for gold. Does TS have any tools for doing Paris trades? I'm sure there's ways it could be coded. Like I said, this is something where you can use multiple data. So you could have something here where you do calculations of one versus another. So what you could do is you could have a ratio, and you might actually be able to, let's go to studies, add strategy. There might actually be spread ratio. I don't see it, but there is something else here. All right, if you go to indicators, and then I got to go after this, go to spread ratio. This can actually, sorry, so we can go to this. Let's just show you this really quickly. I'm going to put in inputs. I'm going to put in data 2 and data 3. I'm going to put it in subchart 3, and let's see what happens. This is going to show me the ratio. So what you could do is you could have like whatever, IWM versus Qs or something like that, like you're asking. When it goes to one spot, then buy or sell. So I believe you could use, if you go into the actual easy language for spread ratio, you could borrow from that and you could combine it with this other stuff I'm showing you to actually create orders. So you might be able to say like, you could have something that would go, what you'd probably have to do is probably have 2 charts. One would be running IWM, one would be running QQQ. And it would basically say that when the ratio goes to X, then buy one, and then the other one would simply be closing the opposite. So you would have one that would be trading the Qs and one that would be trading IWM, and one would be buying the signals would be the opposite. So when it was bullish on the Qs, the other one would close the IWM and vice versa. So I do suspect you could do it that way, as having two different charts. Now, I've never tested this myself, but I do believe that between the spread indicator, the spread ratio indicator I'm showing you, and this strategy that I just showed you now, with the two data, I believe that you could probably create something like that. So hope you guys have a great day. I will talk to you next week. I meant to see the analytics on my last trades. I'm sorry, last question, and the past trades. What you do is you go to data, strategy, performance report, and it's there. It'll show you the transactions. There's actually a trade list here somewhere if you look. So that's how you do it. It's under data, strategy, performance report. Take care, folks. I'll see you next week.